the price on the previous day. So it's basically looking at quote unquote non-movements or inside moves in the market. So first, we're going to take a look at the distribution of non-movement occurrences in the 45-day to expiration cycles. And when we jump to the next one here, as expected, the longer duration, the lower the probability of the stock price coming back to.
Right, well, they're just talking about like expected moves. So if something moves $30 and it has a $3 expected move over a 6-month period of time, it's going to take it a lot longer to get back that price, even if it goes all in one direction. But now remember, from a volatility standpoint, you're talking more about being a lot more mean reverting. Now, we're not talking about volatility here, just talking about stock prices.
Yeah.
A lot of times people get to smoke opium, and since we had this large move to the downside or to the upside so quickly that once it backs off, it certainly can go back there again. And again, it is a 50-50 shot on direction, but it's all about the implied volatility for an expected move, which is 100% correct 68% of the time.
That's good. Yeah, you had to add that one in. That was good. Jump into the next slide. So next, we isolate these non-movement occurrences to test how closely the actual daily premium decay matches the theoretical premium decay. Quoted only the non-movement occurrences. So we're looking at the time where the stock, in this case SPY, was within 0.5% of the price on the previous day. So it's basically looking at quote unquote non-movements or inside moves in the market. So first, we're going to take a look at the distribution of non-movement occurrences in the 45-day to expiration cycles. And when we jump to the next one here, as expected, the longer duration, the lower the probability of the stock price coming back to.
Right, well, they're just talking about like expected moves. So if something moves $30 and it has a $3 expected move over a 6-month period of time, it's going to take it a lot longer to get back that price, even if it goes all in one direction. But now remember, from a volatility standpoint, you're talking more about being a lot more mean reverting. Now, we're not talking about volatility here, just talking about stock prices.
Yeah.
A lot of times people get to smoke opium, and since we had this large move to the downside or to the upside so quickly that once it backs off, it certainly can go back there again. And again, it is a 50-50 shot on direction, but it's all about the implied volatility for an expected move, which is 100% correct 68% of the time.
That's good. Yeah, you had to add that one in. That was good. Jump into the next slide. So next, we isolate these non-movement occurrences to test how closely the actual daily premium decay matches the theoretical premium decay. So this will get, closer to that original slide. The first slide, that was a non-scientific slide. We're going to look at the actual curve of the realized premium decay. We'll jump to slide 7 here. So the curve of realized premium decay looks very close to the theoretical one, with the acceleration in decay approaching expiration. So as you get closer to expiration, of course, you're going to have faster premium decay. You only have a certain amount of time, especially when you're looking at these closer at the money options. This goes to the other slide of mean reversion of price being much closer on a day-to-day basis, or on a shorter duration, because it's more of a 50-50 shot versus a longer duration where you don't have that same sort of coin flip. We've known that obviously in the bull markets in the past years, tested the call side more often than the put side. If we control for the directional bias, does the call premium decay look similar to the put premium decay? And so again, we're looking at these sideways moves versus, a long period of time where we're only, we're looking at the total directional move. This whole study is looking at just those like inside move periods of time and days. So the actual premium decay for calls matches the put premium decay in the hypothetical curve. So again, when you take the directional move out of the equation, the decay on calls and puts are relatively the same as the takeaway.
Yes.
Here.
Yes. Agreed.
Takeaways here: delta is one of the largest risks when trading and can adversely impact traded performance. And this again goes to what we were just talking about here. We took delta out of the equation for this study and just looked at premium decay and tried to kind of compare calls versus puts. Delta, of course, has been the biggest directional, or has been the biggest issue for positions over this period of time. When we control for delta, the changes in the underlying price, we clearly see where our returns come from. They come from premium decay. That's why we're always talking about looking at high volatility and mean reversion of volatility. Theoretical premium decay very closely matches actual premium decay. Since most traders sell out-of-money options, does actual out-of-the-money option decay also follow the theoretical? That will be covered in part 2.
Ooh.
The title is Why Neutral Strategies May Dominate.
A strategy dominates when it achieves equal or higher returns while bearing equal or less risk. So what are we looking at here? We got the expected returns as a percentage and then the standard deviation of risk.
Mhm.
You're saying more risk, more expected return?
Exactly. Less risk, less returns. Next,
Okay.
John.
All right, going on to the next one here. So examining straddles. So it's reasonable to assume that the offsetting delta would reduce the directional risk and the straddle would be more profitable than either leg on its own in terms of risk taken and return. So you're looking at a straddle versus each position. So what you're saying is you have more risk potential just on one side of the market, on either side of the market, whether it be puts or calls. You have more risk on just a single position because you don't have that delta hedge from the other one.
Mhm. So just this will be testing to those individual leg, right? Put or call. And then we put all those risks together, which will be hedging both sides, right? And we
Mhm.
test those results. In the case of risk, we're going to use standard deviations.
All right, so getting on to the next slide here. So how is this how is this assumption played out historically? Does the risk reward advantage of a neutral strategy make it noticeably superior to a directional premium selling? So you're going to take neutral positions compared to one or the other directional premium selling position.
Exactly.
Naked calls, naked puts.
Exactly.
All right, so let's get to the study here. So the study, 2005 to present, every trading day, place trades close to 45 days. So you compare it selling at the money puts, you're managing them at the 21 days, at the money calls managed at 21 days, straddles managed at 21 days, and then the strangles managed at 21 days. I'm a little typo there, right?
Yeah.
21 days. And then so you're going to look at the average returns and the standard deviation of returns, or the standard deviations of risk.
Of risk.
Okay, so we're going to see how wide the risk is,
Mhm.
as well as the returns on all those strategies.
Right. You
Beautiful.
got a lot of data here. This is over the last 20 years, right? 05 till now, just about 20 years, 19 years. So a lot of information. Go ahead.
All right, so the straddle achieved both higher returns and lower standard deviations of risk, even though the call side lost most of the time. If you look at a chart of SPY, it has gone up since that time. So you're naturally going to be losing on the call side. Tell me what we're looking at here. So we got annualized P&L as a percentage of the underlying.
First of all, when you take a look to this table, numbers speaks by themselves, right?
Okay.
When you see at the money call, at the money put, in the straddle, this is the first table we compare the stats on both sides, neutral strategy. When you look to annualized P&L as a percentage of underlining, you see at the money puts have 32%. At the money call, it's a rules trade, right?
Mhm.
Negative 40%. And the straddle outperformed by 40%, which means we have better returns when you compare neutral strategy and both when you compare one leg by its individual stats, right? When you go to the risk, which is standard deviations, here I didn't put percentage. I use actual numbers, actual money, right?
Okay.
So it shows at the money call, it's 130, right? At the money puts 841. The straddle, which is neutral, shows 602. And remember, when you trade, the only logic, which is simple for everyone who trade, we know like if you take huge risk, the return will be also huge, right?
Yeah.
And if the minimal risk you take also returns, you can expect huge returns, right? But take a look to this neutral strategy. Straddle have 602 risk in terms of standard deviation, right? And at the money put, you have 800, at the money calls have 630. So this give us the indication like in real life, we don't need to be mediocre, right? Tom hates this strategy.
Okay.
We don't have to be mediocre, right?
Uh-huh.
We need to take sides. But when you are trading, I prefer to stay neutral when you don't take huge risk.
Yes, this shows me that we've obviously had some positive drift up over this period of time. And then, I'm in both cases of being bullish or bearish. Like if you're on one side of the trade, you should expect to have bigger potential returns, but you're also going to have bigger risk because you don't have there's no hedge in place on entry. And so it's easier said than done to look at 2005 to now and say, oh, well, I should have just sold puts the whole time. That's a hindsight look back. Even if you are selling at the money puts, you're going to see the losing trades, the standard deviation of risk, to be much greater than what you have with the straddle. You don't have the upside profit potential as the naked puts do, but you're going to have wider losses. Your overall standard deviation of returns is going to be much, much wider because of those tail losses.
Yeah. Even if you look at today return in terms of return on your investments, you will see the call, it's negative 1.6, and the puts, it's 1, and the straddle, it's 2%. That's the annualized return on investment we get. If you see the standard deviation of your return on investment, which is the risk, so the puts will be higher, right? Because there's so much noise right there. But the straddle, which is a neutral strategy, will be slightly lower according to the puts.
All right, jumping to the next slide here then. So even the strangle achieved both higher returns and lower standard deviations of risk, even though the call side was a losing trade. And this is, anytime you look at a long time frame, you're always going to have losing short delta positions when you see the market has what, effectively 3x since 2005, 2x minimum. We're right there. So you're obviously going to have losses on any neutral or any short type position. The thing to key in on is that the losses on those select times to the downside are much, much greater because you don't have any sort of hedge on. You don't have any sort of short delta on your position. You're one-to-one to the downside. And you see it here with your standard deviation of risk being, much higher on the out of the money puts.
Exactly. And when you compare this slide with the previous one, you will see this trade-off has potential of losing more than strangle, right?
Yeah.
If you see in terms of risk, the straddle has more than 3x of losing, more than the strangle has. Like for example, straddle have 600 of the risk, but on the strangle we have like 200, right? Which is my recommendation. I don't need to take recommendation, right? But the strangle kindly outperform in terms of risk management when you're looking into long-term position.
Because you have more you can do with it. When you're just selling a put or selling a call, you can only roll it out in time or roll it up and out if you're on the call side. If you have a strangle or a straddle, you can roll. Both those options are bringing in premium and are bringing in value that you can capture over a period of time. Whereas with one-sided trades, if you're wrong on direction, that part of the trade is tough.
Exactly. And I don't think there's someone who wants to do the calls the wrong time because call sucks, right?
Yeah.
Almost to say call sucks. So.
Yeah, until they work, the one once or twice. All right, let's move on to the takeaways here. A couple more. So while neutral strategies appear to outperform directional ones, we may still look to take directional positions to stay engaged and build core positions. There's nothing wrong with having a directional assumption.
Exactly.
However you build it, the things that we control on entry are volatility, time, or how heavy our directional assumption is. Those are the things that you can ultimately control with your positions. However, a purely mechanical approach looking to optimize returns given certain levels of risk may be exclusively to stay neutral if you're trying to take less risk on both sides.
Yeah, we don't mind if you take a direction on any side, but remember to use mechanical approach. for you to control your trades.
And be small.
Yeah, be smart.
All right, last one, takeaways. So neutral strategies don't require any additional buying power, so it's logical to sometimes avoid picking a direction. Selling the call doesn't, against, if you're just selling puts, if you're selling a call against it, won't use additional capital, brings in more premium, gives you a little bit more potential value to capture through the life of the trade. In the example of the SPY straddle and strangle, it achieved both higher returns and lower risk than its individual components. Obviously, positive drift over 20 years helps, but in the short term on a trade by trade basis, better off with the neutral position.
Exactly.
Hello again, everyone, and welcome to the Options Mentor. First off, I want to thank everyone for the overwhelming response I got to my video I put up last week, which was just the recording from a recent long diagonal follow-up seminar that I did. If you haven't checked it out, check that out. People really seem to like it. It's a good basis to start learning about long diagonals.
So yeah, Brother Will, good to see you. I just wanted to put that up there in terms of, I really dig Tastyworks, and a lot of their analysis is why, these premium collection is because you're neutral. You're not picking directions. And that's why I was doing, like I said, I start everything with the straddle or the strangle. Everything for me starts with the strangle. And then I take it from there. Okay, let's hide this. Okay, now here's the deal. This trade EEM, like right now we should have a pretty neutral market. Looking over at their markets, basically flat. Just it's been going up and down, so it's basically flat. What's tech doing? Flat. What is Russell doing? Flat. So let's go to the cost of fear. Just barely down. VIX. In other words, there's a lot of flatness going on market-wise, which might again give some rise to trying to buy more premium or buy an option buying a debt. But even though it's a debt trade, you're still going to sell some premium against it. Let's go to bonds. Bonds barely ticked up about a 0.5%. I mean, it's not like incredible. Let's go to Bitcoin to see where speculation is. Bitcoin speculation is through the roof. The Trump trade, again, in terms of its adoption, this is like what I call the Beanie Baby trade, because in all reality, I mean, when it comes down to it, who really uses Bitcoin and what for other than to, speculate? And hey, there's no problem with it. Hold on. Yeah, everyone wants to speculate. For lack of a better term, they want to, pick, saying, hey, this is going to go. Because earlier last night, Bitcoin was down a little bit. But this is what I call the Trump trade. It's the Beanie Baby trade. Like Beanie Babies and Cabbage Patch Dolls and everything else. I'm not saying it's a fad, because it'll definitely be adopted, But think of it as like beta versus VHS, And I remember those days when beta tapes were out. And then VHS tapes came out. I'm dating myself in terms of how old I am, but that's what it was like back then. You had beta versus VHS. And it was the whole, no, I use beta, no, I use VHS, and it was the whole allure, for lack of a better term, of and again, and that's before DVDs came out or Laserdisc. I remember that. But anyways, Bitcoin is ultra speculative, which is cool. But anyways, we saw where market conditions are pretty much flat with a heightened sense of speculation, because Bitcoin represents the speculation. Do folks want to start betting on red? And you could tell by putting in context of Bitcoin and SPX, although SPX is still flat. Regular markets are flat. EEM, because of the fact that we've got this thing expiring Friday on this, what I'm doing is I'm trying to roll my strikes to the next month or the next week. Just rolling these strikes to the next week, because I still want to stay in the trade, because I believe that there's a good chance that this thing will stay kind of in between my situation. And still yet, we're going to be making, in terms of theta, we're still making $4 a day on theta. Okay. So, for each, day that goes by, even though that we're 7 deltas short, which means, we want that to get back in the middle. And gamma is definitely going to kill us if it moves over $1. We get hurt on gamma. But the thing is on EEM, I'd like to see if we can milk this a little bit by getting more premium. It cost us $77 or 77 cents. We get another 20 cents. We're going to knock down that cost of this. We're just going to keep knocking down the cost. So anyways, that's that. SMCI, we're up to about 10% on that, but that's nothing. That's pocket change. SMCI, it's still, we're going to see where the deltas are at, because, this is a stock, so it can move everywhere. We'll see if it stays in the range. Who knows? And especially when we're neutral, because of a strangle, you got to be very careful when you're neutral with stocks like SMCI and stuff like that, because that thing can move. I mean, what did it do? Even though it's like $6, that SMCI has the ability to move $6 either way. Now, it got destroyed, and we took advantage of the volatility, but we'll see if it stays in this range for a little bit longer. SMCI, we're looking at our inventory. We're still making $7 a day on premium on that. TLT is a free trade, because remember, we got into that and changed that. VIX doesn't expire until December, so I really don't care about the VIX trade. X, we're 4 deltas long now. I think we were short delta yesterday. Now we're long delta today. So still yet, it's still kind of in the hill. Because remember, it was trying to go off the hill, and now it's snapping back. Remember, this is U.S. steel commodity, and so as it goes up, volatility goes against us, and as it goes down, volatility should go for us. Even though it's a stock, it's not the actual commodity. It does represent. At least I've noticed that when it went down, volatility kind of helped us. So, but anyways, we're still making $7 a day in that. If it moves $1 either way, we're going to be losing that $7. We're going to be losing $4 of it, because it is, again, the deltas. And again, these things can move, especially if you got like interest rate decisions or anything. Trump, something could happen to him. Who knows? And then we got the dead trade of XSP, which the short strike, that short strike right here is the one I was trying to roll. That expired. It expires today. I was going to try to roll it to tomorrow, but if I even tried to roll it, we'd only be getting 2 cents of credit. So it is what it is. I'm not really, freaked out, because this is an index, so there's no assignment and there's nothing, it's basically the one we sold. We sold it for $1.91, and now it's worth nothing right now. It's worth, it's basically, 2 cents is what it's worth. So, and I just wanted to go ahead and sell another, roll that and sell another. Now, if I wanted to, I could sell the 582 put, but I would only be getting 2 cents if I sold the 582 put, just to see what would happen. If I sold another 582 put, Yeah, 2 cents. You'd only be getting 2 cents. Yeah, 583. No, you can't because I already have one that's. Am I long that? Yeah, I'm long the 83. Yeah, so these are so far out of the money. There's nothing. There's nothing there. I was just thinking, I mean, I could have mitigated the risk a lot better by getting out of the trade, but I was just wanting to roll it to get credits and knock it down just in case this market decided to crash. Anytime between that election, I shouldn't say crash, but normalize. Because if you look at where things were at, again, these gaps are going to want to be filled. And again, the last thing that you saw in Tasty Works, they were talking about, how long these things can stay elevated before they want to normalize. And that's what we're seeing right now. Yeah. So anyways, new trades, or no, let's go back to inventory. That one that didn't get filled yesterday, the one that didn't get filled, the Riot. And I really wanted that, but it doesn't look like that's going to happen. Yeah, because it's only 10 cents a credit. I was trying to go for 25, and I think it was around 17 cents. Delta Airlines. And again, I just had the prices way too high. So I had 2030 or 230. Delta's up $1. If we go to Delta, we'll look and see. Okay, let's look at our deltas of Delta because it's up $1. So I'd have to adjust this because now we're at a 31 delta. So this thing is actually moving. Let's go to 15 deltas. Okay, only $1.30 credit. There's no way I'd do this. Only $1.30 credit. If I moved it here, there's a 62% chance that this thing's going to get touched. I wouldn't want that. But over here, $1, 230 off of 652. I couldn't do that. A 130 over here, 229 off of 825. I'm not getting paid for the risk. If I did this, 46% chance that'll get touched. We go to Curve. We have 73, 62 in terms of our probabilities, getting paid $7 a day, yet volatility could hurt us. But you're getting 272 off of 8. It's not the best of credit for me. I like a lot of credit. But Delta was good yesterday. It's not good today. So I'm not going to go ahead and labor over that. ARK Invest. This was the one we were trying to get in. Now it's only $3 a credit, which means that literally, the trade we had went in our favor. So there's no way that this trade will, because I was looking at the possibility of ARK Invest, because look at that, it's just skyrocketing of going down because remember, this is the Elon Musk trade. And as Tony was saying, or that what they were saying in there, I do agree with them that these markets can trend before they normalize, but price does tend to normalize. It's all a timing thing. That's all it is. And so if we looked at this, I would have to move all three of these up in order to capture, to make the trade like we did last time. This is just a regular butterfly. When I talked about the lawyer, as you notice, we're creeping the lawyer up. So we would go 25, or let's see, 25, 21, that gives a 42% chance to touch. And 13, that's 19. So, basically we're just creeping up and up and up. Market's not going in our favor, so it is what it is. I mean, it's going in our favor had the trade gotten filled, but it's not going in our favor because we never got the fill. From 19 credit to 38 credit, you see how wide the differences of the bid-ask prices on that. We got a 42% chance that this thing can actually get to us. If we really wanted to get adventurous, we could go, no, because that makes this lawyer a 60% chance that this lawyer will get touched. And that's your delta. That's what we're looking at in terms of delta. If we did this, moving this defendant closer to the courtroom, which is the at the money strike, which is the center line, this orange line. Why are we only getting 9 cents a credit? That doesn't make sense. By moving this up, you should be getting more unless the implied volatility is higher going out, which means the skew. Because now, going down a strike, you're getting more credit. So it could be that implied volatility is higher. implied vols as you're going out. Yeah, the implied. So there's a downward skew to this, which means that there's definitely, but you have, I mean, there's down skew in the puts, and the calls you have upside skew because they think the risk is to the upside because Kathy Wood and ARK Invest are, it's the Elon Musk trade basically. So if we were to do this, it could still fall into that wheelhouse. It could definitely fall into that if we look at our mountain, just to see how, he could easily slip and fall off that mountain because he's already off the curve. But between 13 and 26, it was 13 and 38 before. Now we're at 13.26. Now we're at 12 or 13.25. So I mean, this is all over the place. It is what it is. So, anyways, we're going to try to get it for 20 cents. This butterfly on ARK Invest. I'm just going through the inventory that didn't get filled to see if we even get that trade, if it'll ever fill. And we're going to look for some new ones as well. And I know we were looking for the SPY. See, the thing is these are what I call the anti-Trump trades. In other words, I'm looking for the market delta to neutralize because it's been it's still so ridiculously high that I was looking for to see if the delta would actually get back to where it was at. And I'm thinking, because because of their elections, it just went so far so fast. I'm thinking maybe it'll normalize and it'll start coming down a little bit. But as they were saying earlier, sometimes these things can run for a while before they start to get hurt. It's all about timing, and getting the right timing. I gotta deploy my other strategy for that because I really want to. I'm not using that strategy for time. I'm just using quant, using quant type of trading. Again, just using the statistics to make the trade and not worrying about timing just yet. Well, we'll see. Anyways, looking at Bitcoin, same thing. Okay, we were looking for a 25-cent credit. The best we could get if we got was 15 cents, and they're saying 4 cents. Why? Because Riot keeps going up. Why? Because Bitcoin keeps going up. Why? Because Vivek Ramaswamy and Elon Musk are now part of Trump's cabinet. And look at how parabolic that is. So I'm just looking at some of this to come off. It's like a meme stock, an ARK. Let's take a look at Riot. And look at that. Let's get a similar order of Riot going. Riot, which is a Bitcoin stock. Let's look at the chart. Same thing. Look at that. Just ridiculous. This is looking like there's a possibility that it may want to go back. And if it does, I want to take advantage of that. The thing is the volatility is the only thing that I'm a little bit more nervous about because the volatility is so high. If I did something, chances are that volatility may come in. Who knows? And that'll be against you. This thing can easily move. The Riot says it'll move like $1.90, about $2 a day in the last 21 days. It's only 3 cents right now, but I'm always looking. I always double the ATR to say what could happen if I did Riot as the butterfly, because again, thinking the volatility might come in a little bit. I want more. Okay, now there's 20 cents a credit, so now it's just okay, we were looking for 25 cents. Okay, now 18 cents. Okay. Because I had that. So 18 to 25 from your credit, the mid price to the ultimate thing you're selling it for. I'm a cheapskate, so I'm gonna go at 20, or now it's 14. So this thing is moving. Markets is still early, so I mean the prices are everywhere. They're all over the place. But 15 cents is your mid price. I'm trying to get it a little higher than the 15 cents. I might not get 25, but I want to go in between 15 and 25. 21 sounds good to me. So I'm gonna continue. The 12 put is our short strike. That's where we will have to do something. Either take off the one part of the trade or just get out. And that's 12, which is right around here. And it could get there. It got where it's at in less than a week. It could get here. Especially if, and remember, this is a trade we'd have to hold at least at least since we're doing it on Riot, since we're doing the trade for December expiration, we would have to hold this for at least 2 weeks before, we start seeing some kind of, major benefit. Unless it goes up, then we're cool. Riot, it's still sitting on the hill. See how close it is on the hill? It could easily fall back into that 12-put area. So it's on the hill. Let's take a look at where the deltas are at. The deltas, we've got a 54% chance that that thing will get touched. And that's why it's on the hill. We can bring this down delta-wise. And you have more risk to the upside. Look at the implied volatilities. Everybody believes this thing is going up, more than they believe it going down. Yet you do have this skew, and of course, the out of monies are getting a lot more expensive. So, so now we've got a 12-cent credit. Our deltas, we've got a 38% chance that this thing will hit down where it's at, which is kind of okay. I mean, we've got we were at 12 to 24. So if I want this, I'm going to go closer in terms of getting credit. I'm going to go to the 18 and see if we could get 18 cents of credit. Even though 9 is our, I'm going to double that just because the distance between the maximum credit we could get and the mid price. I always go in between there first and see you making 44 cents a day, 91% chance of making 50%. Why? Because the market's chances are you'll make that $9. 75% chance of making a penny or more. You are long deltas because remember this is a butterfly. You're looking at, your short strike is underneath near your short strike. So this is definitely a bullish trade, but it's capitalizing should this thing either stay where it's at, go up a little bit, or not fall too much. You're risking in order to make 118, you're risking 82. So that one, let's see if we place that one yet. We got Riot working. We got ARK working. Let's see. And these are ones for the counter trend trades, the directional ones we were talking about. That's all these are, is directional. Purely directional. FXI. We got out of FXI the other day. Sold that. Yeah, we got out of that trade. That came out pretty okay. I think it was like 30%. So looking for new trades. Watch list. I was looking at Coin, but Coin, that was the one that I did yesterday, and I did the strangle. It was cool that I saw that Tasty was doing the same thing after we did our session. I was like, yep. So implied volatility, high implied volatility. Look at all this. I've never done Occidental, and it already went down. Occidental's down 2% volatility. I don't want that. Boil. Coin is the only one that I could see possibly doing because the king is there, volume. Queen is there, volatility, especially on the 5-day volatility. MicroStrategy is the same thing. Yet again, that's a $300 stock. You'll have to do that defined. Coin, you'll have to do that defined. Okay, Coinbase. Patterson, I've never traded that. There's not a lot of liquidity, only 375,000 contracts. If we look at that, there's no liquidity. Go into here, go to volume, no liquidity. Remember, liquidity is king. So let's go back and look for some trades. So far, Coin and MicroStrategy look possible. It'll either be one or the other because they're both Bitcoin oriented. I don't like to double up, and I like to spread the positions around. And I already got Riot and ARK, which are also Bitcoin positions. Selling premium. What else do we got? Tesla. I don't like Tesla because I don't like Elon Musk. But yet it meets all the requirements. And when I say don't like Elon Musk, it's too, I mean, it's just anything can happen with Tesla, and it's in terms of its, leadership, it is what it is. KRE still looks kind of good. King is good. Queen is good. Went up. So let's see what we got in KRE. We may have to do this as a neutral or as a defined risk. So let's see what KRE looks like. In the chart, look at that KRE, which is, I believe, regional banking. regional banks, ETF, it's spiked. Why? Again, Donald Trump. Chances are it could even out a little bit, range a little bit before going down. Who knows? I don't care. This thing can move about $3, a little stay at $3.50 a day. Even though it's only moved 52 cents, it could easily move $3.50 a day. Why? Look at that gap. Anyways, let's go to December 20th. It's only 37 days. We'll have to go to January and see if there's any liquidity out in January. Let the chart or let the option table populate a little bit. I see no liquidity at the standard deviations, none, 0. If we did it in November, we'd have to do undefined risk so we can move those strikes. So if we did it on the December, no, we'd have to do it on the December, excuse me. See if there's any liquidity for us. We'll let this thing fill up. And, okay, there's some liquidity here. Hold on for 1 second. Remember, liquidity is king. That's the first thing I look for. Is there liquidity? Because without liquidity, you won't get good volatility studies because you won't get a real price. You got to have liquidity. You got to have, the L word, liquidity. If it's not there, I can't trade it. Okay, closer to the 16 delta, there's only one contract. We'll go, if we had to do this defined, say we did a 62.59, there's really no liquidity on that. So 62.60, and then we did defined risk on the other side. So what is that? We're at the 21 deltas. Say if we wanted it delta neutral, we go 73.75. We could possibly go 74.76 to make it a little bit more. So we're close to delta neutral, and we make $1 a day, 72% chance of 50%, 62% chance of making at least a penny or more. You're getting 58 cents on the $1.42. It fits all because you're getting a third the width of the strikes. It fits everything there. Everything looks like it should. Let me see. We've got volatility is kind of in the mid in terms of where it's been trending. Not to say it'll go up or down, but chances are this thing could get more volatile. Why? Because of the fact that the Donald Trump trade wants to fill the gap. Not like it has to, but more than likely will. We've got, our risk is 142 because our strikes are, so it's more binary, which means it has to stay in between those. That you're not going to have a lot of room to move. It's very binary. But when you move it, it's going to be very cheap to move these strikes. We're on the top of the hill, yet we've got a little bit more upside, to where, the higher it goes, the more we can lose. If it went up there tomorrow, we would be losing $31. If it went down to the downside tomorrow, we'd be losing $24. And I'm talking our short strikes, but I don't care. I like this. If we were to move the strikes, if I moved it up, remember every time I get into a trade, I know I'm going to adjust. If I had to adjust this, and I was thinking about doing $5 strikes. Say it moved on the upside to us, and I wanted to capture premium. If I moved it up here, that's 81 cents, so that we'd be getting 30 cents, and it really doesn't. It impacted our buying power by 60 cents. Little over 60 cents if we had to do that. If we went on the downside and we had to move this, we have the 74 call. Say if we had to do that, and all things being equal, we moved it down a strike, we'd be coming up again, from our 58, we'd get 20 cents. And, again, we'd be up. We would be paying, it'd be like double what we would, our buying power. Or it'd be double the addition to our buying power. At a 142 buying power, it would be over double of what it would, the addition. So we would be adding 60 cents to our buying power. It would be double what we got on credit for buying power. So if we're getting 30 cents in credit, our buying power goes up by 60 cents. So, so that's something to take into consideration. If I did this, since we've got 57 to 62, I'm going to put this at 60 and see if this thing will get around, if it'll get filled around 60. I don't mind this trade. The only other thing that I could do is say, all things being equal, let's see if these strikes, because we might not have these strikes, and this is December. Let's see if we got the 60, 62, 74, and 76. 60, 62, 74, 76. Yeah, so it's hard to say because there's no liquidity here in terms of we'll see if there's any liquidity. I wanted to see what would happen if a week goes by, or 2 weeks go by, or 3 weeks go by. We could do it through the analyze tab, but sometimes that's kind of, I'm not really a sycophant of Dealtrade's analyze tab yet. I mean, not Dealtrade, Tastyworks analyze tab yet. Still trying to do it. But if we were, say we use implied volatility per contract, theoretical, let's see what our theoretical would be. Okay. If we went and this thing, all things being equal, we go 2 weeks from today, 1, 2, say to November 27th, we'd be up 13. Okay. Theoretically, theoretically, that's what they're saying. So anyways, which is 10% of the buying power. So in 2 weeks, we get our 10%, all things being equal. If this thing fills, that's what we get. Anyways, I'm going to send this. And then we got KRE in the docket. Okay. I don't mind that. The thing is I want to get at least, I'm not going to get the 60 cents, but at least I want to get 30, and that's per contract. You do 5 contracts, it's $150. But I'm just showing you one contract because I want you to trade small, just so you could get used to it. Exactly how this thing is. Anyways, going through it. KRE, anybody else? I think I still have a metals trade. Do I have any metals on? I have no metals. I've been doing okay with metals, not great. I have no metals. I got out of metals earlier because we did make that trade and grab that profit on SLV. So let's see if we got some metals. GDXJ and GDX, I've been in and out of those. I do have Delta Airlines. Let's go real quick to Boeing. Yeah, I would rather do Boeing than Delta. Yeah. Because the Delta didn't give us the so King, a lot of contracts. Queen, good volatility, and it's gone up a little bit in volatility to see what we could sell. Remember, the King is volume, Queen is volatility, Prince is expected move, and we didn't see what I did with the trade that we just did on KRE, just so you could see it. So that way you could see KRE, the Prince, we could look at him, similar order, and therefore, because I want you to see this in terms of expected move. Okay, we are very close on the downside to the expected move, but not on the upside. Again, because of that skew of the mountain, the delta, a lot more to lose up there. So when we did our putting this together, the Prince, looking at the expected move, we're right outside of the expected move. They expected to go $5 either way. So we're right on the tip of that on their $62 strike. That means that we do have, it would be cheap to go ahead and move these down and capture some of that premium back. So I don't mind that. I don't mind that whatsoever. So let's go back to Boeing Airlines. Boeing Airlines. Okay, 37 days. It's cutting it close for undefined risk, but we'll look at the deltas and we'll look at the, 19 is closer to 16. Go to 19 deltas. 19 deltas, we're delta neutral. 84% chance of making 50%. 70% that we're going to make a penny or more. Everything's cool. We're making, except for 1/5. That's not really fun. If that thing had at least 500, I would go in and make this trade in a heartbeat in terms of the credit that we receive. And that's the December 20th. Let's see if there's any volatility or any volume on the January strikes in terms of those 19 deltas. Okay, 17 deltas, January. Okay, there's a tiny bit of here, the granularity of deltas, there's nothing there. Okay, there we go, 21 deltas. Okay, there is some. I like more room, so let's go to January. So we go to 17, that's closest to 16, and let's go to 17 here. being that that's outside of your expected move is still telling you that there's still some more delta skewing to the upside. That delta is 204. This delta is 215. The price is more in terms of the option, but just when I say that this delta skew is the higher it goes, if it went all the way to your short strike, you'd lose more. Okay, and again, this one right here is we go out 1, 2, 3, 4 strikes, 35% implied volatility. 1, 2, 3, 4 strikes, 39% implied volatility. We can go 1, 2, 3. It doesn't matter. 40 from the 45, we'll go 1, 2, 3, 4, 5, 6. We're at 40% volatility out there. We went 1, 2, 3, 4, 5, 6, 37. So the options are more expensive. That you're looking at the further out you go, of course, they're going to get more expensive. You got more upside skew. But we do have volume. If I were to do this at the expected moves or where we're at right now, I'd do it defined risk. We'll take the $5 strikes and see what we could get. Okay, we're only getting 1/10. No, we're getting a little bit less than a third the width of the strikes. I'm not pissed off on this trade, but it's not like the best trade because, again, we got a 78% chance of making 50% of this 117. Theta, we're getting paid $1.51 a day. We got probability of profit, 67% of making a penny or more. We are a little bit delta long. So if we were a little bit delta long, we could do this and see if we could. Now we're even deltas, but we're making less. We're only making a quarter of the width of the strikes. So, that's not necessarily fun. In other words, if we move this down, we're getting closer to the mountain. We're getting closer. We're evening up our deltas. We got a little bit more credit. We got but the probability of profit and the probability of 50% really didn't change as much as, So we're just, we're just getting a little bit scarier in terms of what we can lose. Buying power went from 376. Well, I don't mind. Now we got a 44% chance that this thing will get touched. Before we only had a 35% chance. Now this thing could get, and remember, this market has been moving up and up and up, and it could easily move more than $10. It's $2 now because it's kind of settling in, but Boeing can move easily $10 on us. Remember, double your ATR, and I always look at it that way. So if that's the case, I'm saying, hey, if this thing can move $10 against me, I got to be real prepared for it. Why do I prepare for it? Look at our mountain. Where it's at right here, it's at the 142. If it got to 152, we'd be down. Okay, we'd be down about $20. If it got to 132, we'd be down about $30. The thing is, if it moves down here, remember, if we're looking at our deltas, okay, and remember, around 15 to 20 deltas, we want to change this. If this thing went down and our deltas, it goes against us. Where's my delta line? Okay, yeah. Okay, if this thing is down here, where we would have to adjust our deltas. Let's see, just double check. So I'm trying to think where we would start to adjust on our deltas. I would actually, if this thing went down against us and I had to move this from the 165, that would increase our buying power, doubling our buying power right there. If we moved it, we'd go from 142 on our credit to 223. So that's about 80 cents of credit to double, to add another 360. So it would cost, again, I always look at this in terms of adjustments. How much would it cost to adjust? So it's going to cost a lot of money to adjust this. Do I want to tie up that kind of money is what it comes down to. Do I really want to tie up like a $700 to get another dollar of credit? That would be, let's see, from 136. Yeah. To get another dollar of credit, do I want to tie up? Do I want to double the amount of buying power to get a dollar? You know, and that's what it comes down to. So this is, I'm gonna keep this in the wheelhouse, but I'm not really, the unfortunate thing about Tastyworks is you don't have the ability to save this particular thing, and that just doesn't make sense. Because I would love to come back to this to be able to just readjust and say, hey, what if? But the inability to save it is just ridiculous. That's the only well, not only, but that's one of the major downsides. That, in Thinkorswim, you could do it. You could save it. Okay, any emerging markets? Okay, we're gonna look at gold. Let's look at gold. I've been trading GDX. GDX is one of my favorites. GDX, SLV, because I do want some. Look at Robinhood. I've never really traded Hood. It fits all the criteria, and I think all the earnings are over with, so we don't have to worry about earnings. So let's see what's going on with Robinhood. Overview. Quote details. What's going on? Something going on with Hood. 11% volatility. Hood, Elon Musk effect, Bitcoin effect, the whole 9 yards. Speculative, because Trump's in office. My thing is, where's volatility? It's kind of in the medium. This thing can move $3, even though it's only moved 27 cents a day. Has the ability, if you look at the last 21 days, of moving $3 a day. Let's go in and look at, okay, if we're going to do this as a strangle, it's cheap enough to do it as a strangle. We could go 39. It's much better to go a little further, but 39 days out, we'll go to the 16 deltas. Okay, 15 is closest. A lot of upside skew, delta skew. Let's look at the implied volatilities. This is upside 71% there, 61%. Yeah, this ridiculous upside. So if we went 1, 2, 3, 4, 5, 6, 6 strikes out, that's 63 cents. 1, 2, 3, 4, 5, 6, 6 strikes out, there's 105. Upside skew to the max. In other words, they believe this thing is going to go through the roof. We're only getting $1.16 on $8 of buying power. So that's definitely not a fun thing that I'd like to look at. Let's take a look at the next month and see if there's any volume on the 17 deltas the next month out. January and Robinhood. Okay. At 17 deltas, let's look and see if there's volume there. Remember, the king is volume. Look at that. 17 deltas. We do have a little bit. Let's clear that. Let's go to, because remember, we want to go to 16, but 17 is the closest we're going to get to at its expected move, the prince. And let's go up to the upside and see where that is. See where the 17 deltas. Again, you got that massive skew that goes out there. Massive skew. So they believe this thing could easily get to $45. You got 77 contracts, 148 of 678. I don't like tying up that much buying power, but because we have all this skew, what if we did a 45? Let's see if there's anything at the 50. 45.50. Man, they believe Robinhood getting the $50. And we go from 27.22. There's not really any volume here. We can go 30.25. No, because that puts us into a 58% probability that it'll get touched. But look at all those contracts at 25. So if we did 25, so 27.25 at $2, and we did, because I like volume. That's important to me more than anything else. So yet 41 at a 159, you're not getting paid for it. It's not really, it's less than a third the width of the strikes. So it's not worth it. Only getting 42 cents. But 42 to 68, look at the spread between the mid price and the credit. 42 to 68. So that's crazy. So I like crazy. So what do? We're going to go right in the middle of that. and see if it'll get filled. We'll go, instead of 68 or 58, we'll go 56 just to see. It's crazy, but hey, we're getting paid for it because then we're going to get that third the width of the strikes if it ever fills. That's Robinhood. So we got Robinhood on. Let's find some more that we could sell. And that's why I got to hand it to Tastyworks. And these are the ones of selling volatility. I still want to buy volatility. And that's why I'm looking at that SPX, but I'm putting a lot of trades on just to show you, okay, EWZ, Plains All America. I never traded that. There's no volume there, no king. Hood definitely has enough. That's 8 million contracts. Again, that's the Donald Trump play. Metals, the only problem with metals is that I noticed the volatility went down, and I don't like that. In metals, gold went down 0.5% in volatility, which means it should be going up. If I'm not mistaken, it should have bounced. No, it didn't. GDX. See, that's the thing. Oh no, it goes down. Yeah, when volatility goes up, that means it goes down on commodities. It's reversed in stocks. So if volatility goes up or goes up, market goes up. Yeah, okay, because we're looking at the opposite. That's why I had it mixed up. My bad. Because commodities, when markets get higher in price, volatility goes up. Because commodities can't go to zero theoretically. Oil did back, what was it, 2021 or something like that? It went negative. But let's see what else. We tried that SMH trade. Volatility went up. No, we don't have any SMH on, do we? I don't think I have SMH on. I know I have SCMI, but I don't think I have SMH. That was one I was trying to get on, but it never filled. Okay, let's go in and let's try to find some more that we could sell. Some volatility, because one of the things may get filled. Look at Tilray, that penny stock to the core. 7.5 million contracts. I wonder where those contracts are trading. Tilray is ridiculous in terms of let's go to that volume. I want to see where that Tilray. Where was that at? Volume. There we go. Tilray, where are you at? That was around 8 million or something like that. Look at all these contracts. I love the volume on these. I mean, that's first and foremost, volume. It's got to have volume. Tilray. Look at that, 44%. So everything we've got, 119% volatility. It could either go to zero or it could go to like $3. So if we were to get into this, 37 days is not long enough, but we could still do it. You still want more time. There's nothing there. I wonder where those contracts are. Those millions of volatility. Okay, there we go. Okay, now we're looking at something. So somebody's believing, there's a gangload of at the money calls. They believe that Tilray could go up. Do they believe that Donald Trump's going to be good with marijuana? Who knows? Tilray's been getting slaughtered, especially after Trump. But somebody is believing in Tilray for some odd reason, and that's a marijuana stock. Let's go to January, see if there's any liquidity. Yeah, they got some liquidity in January, not on the put side, but on the call side. So, and these are out of the money calls. Interesting. Maybe somebody thinks Tilray will go to $2, and so they're gonna play the spread of the out of money call. Let's look at the implied vol. Maybe they think who knows? Yeah. So they're selling the 2.5 and buying the 2 implied volatility in January. 2 cents to make 47 cents. So it'll cost you 2 cents, $2 to make $47 on Tilray. That is crazy. Let's look at the curve. Let's analyze this. $2 to make $47 on Tilray. That's the implied volatility that's there. Okay. Why am I not seeing my curve? Okay, Tasty, show me the money. Show me the curve. Analysis. Default. Okay, let's look at the theory. I'm not getting theoretical or nothing. But anyways, this thing, okay, it's going to cost you 3 cents to make 47. Max profit of 47, max loss of 3. Okay, that needs to be done. That trade needs to go on. Why? Because this is crazy. That's per contract. So I'm just going to do it because I'm looking at that. I mean, that's Tilray is it's ridiculous, but I like ridiculous. You're only. I mean, look at the. I mean, I guess that's the implied. That's what the implied volatility is showing. The max profit is 47. Max loss is $3. I don't mind that. And if I did that per contract, I could do 10. So I might do 10 contracts of that. If it gets filled, I'll do another. Then I know that there's liquidity there to fill it because clearly there's liquidity. Then I'll just go in and the price might go up since I do it. So I'll spend like 40 cents to try to make, I'll do, try to make more of that. I don't mind this trade. I mean, it's a out of the money shot. It's a lotto ticket. It's directional, but hey, why not? Hey, I don't mind it. You're definitely 11 deltas long on this, and you only got a 50% chance of making 50% on this trade. I mean, you don't even have 50% chance. But the thing I like is it's a crapshoot. It's a lotto ticket. It's directional, whatever. Why not? It's cheap. If it gets filled, then I know that somebody up there is thinking that this market could go up. For our downside, okay, because we want to buy volatility. Okay, GDX is up a little bit in volatility. Let's take it and take a look at this. We'll go to the January because I always go out 65 days on these metals. The metals have just been, I mean, I've been doing okay with them, but they've been hurting me left and right when I'm not going out long enough. I'm doing more adjusting. And anytime I adjust more than twice, I get out of the trade. 16 deltas. It's outside the expected move. That's good. So it's pretty much, okay, so we're close to delta neutral. 88% chance of making 50%. 98 cents on 361. I like that. We're almost a third, not a pure third. So everything here is looking okay. 35.41. What if we brought this into the 30? Know that because that gives it a 48% chance. How much more can we get? So 111, 91. So we're getting an extra $20. And our buying power literally has not moved much. So I don't mind that. Okay. So if we did 45, let's see what we got here. Okay. 45.32 or 40.32. Okay, it is what it is. Say if this thing went 1 week back, let's see. Okay, we make about 40 cents. Okay, and that's 1 week. We could easily get our 50%. We got an 85% chance of making 50%. We've got $2 a day we're making on theta. Every dollar that this thing goes, I mean, every point in volatility it goes, we're going to lose about $9. We are a little bit short deltas, so let's even our deltas. Let's get back to delta neutral. So we got $1 at 361. It's not the third that I would love, but it's more comfortable there. I have the ability to move, and again, I'm always looking at adjusting. What would happen if this thing goes against? Look at that curve. That curve, even if we expand this, the gamma curve is definitely kind of steep. What do I mean by steep? Remember, if it goes to the upside and it goes against us to the upside or goes against us to the downside, if it shot up there tomorrow, we'd be down about 134. If it just shot to the upside, we would have to move. So, and if it shot to the downside, we'd be down 75. So the mountain is definitely you falling off the mountain to the upside at your short strike. You'll be down further off the mountain than on the downside. So you got to take that in consideration. If I did this trade, I'm going to ask for the full 108 credit. I'm going to go up to the 107 because I want to get paid for the problems. Okay, if I'm gonna take out 357 out, I want to get paid for the problem. I don't want to just get in there. So, anyways, but I do like metals. I've been doing these metals trades left and right all year, just because metals has just been moving. Then let's see what else we got. What else do we have? Okay, then that's when we're selling volatility. We've got a lot of volatility selling. Now I want to buy volatility, and that's that SPX or XSP. Even though this trade is going against us and we're getting hurt, I'm a glutton for punishment. I'm gonna do it again. I'm a glutton for punishment, and thus I will do it again because that's just who I am. But the thing is, if we look at XSP, it's starting to want to roll around. And I just want to take advantage of just the next few days. So if 586 is where that gap started. And that's what I was looking at, saying, what if? 586. If this thing was going to happen around the 586, let's see if there's any interest. Anybody believe this thing around there? That something can happen at 586? Let's take a look at this. 586. Say now, I went out about a little over a week and a half. I think I'm gonna go out a little further. Give ourselves a little time to be right. So if we did like say if we did like 15 days, around 15, 16 days, let's see if there's any liquidity out there. So give us 2 weeks to get to be right. See if there's any liquidity around the 586. I see no liquidity on this. Zilch. And I don't want to go to the monthly. Maybe we'll just have to. There's no liquidity. Before there was liquidity because of an election. But I really don't like going out to the monthlies on calendar spreads and stuff like that. There's no liquidity on this. SPY, I know we should find liquidity there. I just don't like the assignment risk. Let's go to SPX. It's just SPX is more expensive. So we went out 2 weeks on SPX. And then the 5. Let's see. This thing, they're looking at $112 move. We're at 593. Or 598, excuse me. So 5982. If we went down to where we thought that this had a 60, so we could say 592. Let's see where that gap was at. That was around. See 5866. I wouldn't go that because they're looking at 112 expected move, and I don't want to go out that far. I want to go I want to be in the trade no more than like 2 weeks. So. I mean, no more than a week, excuse me. So going 2 weeks out, in a week, we're looking in about 7 days. They're saying this thing can move 69 cents or $69 from where it's at. So if we go $69 from here, we're looking around 59, what is that? 59, 11, somewhere around there. 59.11ish. 59, we'll say, so we'll say 59.11, so we'll say 59.15ish, and see if there's something out there 2 weeks away that we could get around 59.15ish. Should we think that this thing can fall? And all we care about is just getting, so 59.15, okay, the 27th, oh wait, there's no liquidity. This is SPX. It should be totally liquid. I'm not saying anything. Okay. You know, because we're talking pure liquidity. You know, that's the most liquid thing of this other than euro dollars. Let's see. So 14 days out. You know, I don't know why it's not showing any liquidity on this. This is the SPX, the king of all markets. See, I don't want to go any closer. Going closer is not real nice. Okay, we'll say the 29th, which is 16 days out. 59-ish. Yeah, there we go. So if we went to the 59, say 59.20, we sold the 29th, 16 days, and then we buy. So the 29th, and then we buy a few days later. So 29th, December 2nd, this is the Friday. So we're buying that Friday, we're selling that Friday, and then Monday, Tuesday, Wednesday. So that gives us 3 days. We'll go forward to December 5th. Do we have anything at the 59.20 on December 5th? Okay, we'll wait for the market to give us some numbers. Why do I not see any liquidity on there? There's no volumes. No volume on that. Where is it? Where's the volume? Pump up the volume. Not seeing it. Not seeing it. No volume on this. Delete this leg. So let's go back down December 4th. December 4th. That's 21 days. Do I have any volume? Pump up the volume. Because I really, really want a calendar spread to buy volatility. 59.20. I want to buy volatility. So it cost us about $600 for this. We are making $18 a day. Vegas, definitely, it's like $76 on Vega. For each point of volatility, you make $76. You know, hold on for 1 sec. The thing is again, it's a speculative trade, which means if we did this on the XSP, it would be $67 on the XSP to go out November 29th, December 4th. Let's see on the XSP if there's even anything trading like that. December 29th, XSP, December 29th, or November 29th. I keep saying December. November 29th, 592. There's nothing trading here. You can go to the 590, but I don't think it'll ever fall. And there's only one contract. Yeah, there's nothing here. What if we went five? There's only one contract. I mean, I wonder if there's any open interest in here. I mean, there's a little bit of open interest, but there's really no. The king is missing because this is not really a liquid instrument. But if I did this, the 29th and December 4th, because remember, you need liquidity in order to get in and to get out, but it costs around 69 cents. You get $1.80 a day. That's if there was liquidity here, but there's no liquidity, so it takes this off the table. And I don't like using spiders, especially in calendarized trades. You know, calendarized trades are like the worst because you got that assignment risk, and that's why I had to monitor EEM so much, because now we're short deltas, but I really want to get we're 21, 22, mid price is 21 credit. We're going to try to get that 21 cents of credit. Again, if they're going to give you a penny, get a penny from them. So hopefully this will move us over and we'll be able to roll this strike, this Friday strike. We'll roll it into next week, but there's no liquidity. Okay, never mind. There's no liquidity on this. Let me see if we rolled it. Let's see if there's any liquidity on November. That's the 22nd. Is there any liquidity on November 29th? There's barely any liquidity on November 29th. let's see, November, let's see, 29th, December 6th. Is there any liquidity? See, there's no liquidity out on this. So we'll see what happens. You know, I just wanted to roll this thing out as much as I can to these next months, so that way I could capture some more credit. That's all this thing is capturing credit. You know, that's, you know. So anyways, I really want to do the calendarized trades. I really want that. We do have a bearish trade in VIX, but it's so far down, we wouldn't be capturing much. The XSP or the spiders are the only ones that I look at. I could look at Qs, but if I'm going to trade Qs, I'm going to trade spiders. You know, if I'm going to do Qs, I might as well trade spiders. But I don't think this thing's going down anytime soon because of the fact that, you know, the Trump effect. So the 29th, December 4th, for $68. You know, I'm not mad at that trade. It's just there's nothing there in terms of anyone trading it. There's no liquidity. We got to find liquid. Anyways, that just gives you some concepts of what I'm looking at in terms of, you know, buying and selling volatility. KW, good to see you. That gives you just the ideas of what I'm looking at for buying. There's a lot of trades that are I only think maybe one or two of those will get filled because the prices I'm asking are either too much or too little. And then what I do is I just move those, as the market goes during the day, I move those prices kind of closer to the price they're asking. You know, because if somebody wants me to buy something, I want to buy it cheap. So I'm going to start extremely cheap and then just move it up a little bit by little bit while I'm waiting to see if they'll come down in price. If I'm selling something expensive, I'm going to sell it as expensive as I can and then move my prices down and down, hopefully getting the folks to go ahead and buy it sooner or later. So that should give you some ideas. There's a lot of trades done today. Give you some ideas of what I'm looking at in terms of, you know, just getting in and out. If I have some more ideas coming in the middle of the day, I'll go ahead and do another video because that's all it is. You know, so we checked markets, checked inventory, readjusted what we had in the inventory, looked for new trades, both not only selling premium, because I always sell premium, that's mostly what I do, but also looked at trades for buying premium, and we got the directional trade, especially if Hood ever got, you know, if Hood ever got filled, I'd laugh. I would laugh so hard, and then I would load up on Hood. Because the thing is I don't mind losing $40 to make $400. I don't mind that. You know, that's fun. Those are a lot of ticket trades. I don't mind that. So anyways, that gives you kind of an idea, you know, in terms of what could or could not happen. And, you know, yeah, exactly, brother. Well, I mean, hey, it's a lotto ticket. You know, it's a 10-to-1 risk reward, you know, and the implied volatility. When the out of the money strikes are trading over the at the money strikes or the in the money strikes, that tells you that somebody believes that market's going to go in that direction. In other words, what they're believing is chances are they're going to make a spread trade like a vertical spread because the out of the money strike is taking off all the cost of the one that's closer to you. So it costs a lot less. And if it goes up to that short strike, you literally have made the cost of that spread. So if it goes $1 or $2, then it paid for itself. Kind of like what we did with that free butterfly trade. You know, it moved in our direction, and then we just moved the strike up because it was already, you know, cheap. So now it's a risk-free trade. It could go down, up, sideways, and you're still going to make money regardless of where it goes. You know, it's a free trade. And I do a lot of that. Like if this vertical fills and it works and you've made your money, you'll move that vertical up. Therefore, it's a free trade, and then you can put a vertical on the top and turn it into a butterfly. And therefore, you know, as long as you get that credit, then it becomes a risk-free trade. So it could go up, down, or sideways, and there's no risk to whatever you do. You know, you have a trade that literally has no risk, and you just keep whatever profit. You know, and that's what I like to do, is just to try to find ways of making risk-free trades. Anyways, hopefully that works. Y'all take care.